stay on because, one space that has been doing extremely well is this entire technology space. And one of the stocks that we're looking at is Happiest Minds Tech. It has been 1 year to that listing. So if you were an IPO investor, you would have clocked in returns of 800 times on the stock. The current market price is around 1,500, not 1,500 crores, it's 1,500 rupees. And the issue price was 166. So the return for IPO investors is what, 800 times. Phenomenal. We have Venkatraman Narayanan, the MD, and the CFO, and Joseph Anantharaju, the Executive Vice Chairman and CEO of Product Engineering Services at Happiest Minds, who joins us now. Gentlemen, morning to both of you. Mr. Narayanan, I want to start by asking you about what the way forward could look like, because earlier you had guided for a 20% organic revenue growth over the medium term. But in the near term, how do you see things? Has demand picked up in a big way, or do you think things have plateaued?
The demand scenario has only gotten better from where we were at the end of the first quarter when we met last time. And things are looking very good from the customer addition or growth of existing customers as well. So demand is good. And I'm sure it will lead to also the supply situation. Supply situation is also not as good, but we are managing to hold on with employee net additions of about 300 in the first quarter. As I've been mentioning, we are trying to keep up to the same or similar numbers. I would be happy if we did similar numbers for the next 3 to 4 quarters given the demand scenario.
Okay. Yeah, supply side challenges, manpower challenges, which means big salaries, right, and high attrition. We'll get to that in a bit. But Joseph, thanks for joining in. By the way, congratulations to you guys on a great year on the street. So can you give us some more qualitative inputs on demand as well? So far in the second quarter, I mean, what are the kind of inquiries you've seen from clients? What's happening with deals, deal sizes? More qualitative inputs on, what the future of this demand looks like over the next few months. Joseph, you're on mute, I think.
Sorry, I was on mute. Yeah. So if you look at it from I'll probably take 2-3 angles. If you look at it from a vertical perspective, most verticals that we are operating in seem to be showing strong demand growth with customers initiating or implementing digital transformation initiatives. A few of them may be a little bit ahead or having more spend, like edutech, which continues to be strong for us, high tech. Retail, we're seeing a good spend, with the whole e-commerce move. And again, in the media space, the move to digital media, we're seeing quite a bit of initiatives out there. In terms of technologies, one area, artificial intelligence, I would say cloud is almost a done deal now, right? Most of our customers are operating on the cloud, and a lot of work happening around leveraging artificial intelligence, analytics, to get more predictive, to improve your recommendation and things like that. One thing we've noticed in the last few months is customers looking at more of automation. I think there are 2-3 things out here. One is just the whole remote working leading to more automation, and equally important is the supply side challenges. Customers are looking, how do we get to use technology more? And so we're seeing strong uptick on automation as well from a technology angle. Geo-wise, all geos continue to do well. I think in each and every geo that we operate in, customers are looking to adopt digital technology. So I wouldn't really call out any specific geo. The demand is strong across geos.
Mr. Narayanan, I want to come back to that point you made about how demand is good, but there are still some supply side issues. And in that context, do you think the supply side pressure has gotten worse because your subcontracting costs have risen? Your attrition is now almost at 15%. It jumped up in Q1. A, have the supply side issues worsened? And B, is this peak attrition, or do you think it could get worse?
If I were to take a stab and make a prediction, I think things are going to get a little bit worse and then start improving, because you see there is always a slow build-up when it comes to attrition, and the pipeline then slowly builds up on people moving out, looking for the newer opportunities that are on offer, while we keep adding and backfilling the open positions. So both of this is happening on at the same time. So it's likely to get worse. I would say from our numbers of 15% last quarter, it's likely to increase and then we'll be able to stabilize it over a period of time. Because right now there is so much of demand. People are hiring for digital talent. They're looking for places from where they can ramp up very quickly. So sometimes there are decisions which are not very logical that are taken essentially on the compensation front or on what's on offer. But, you know, the IT industry has kind of matured, the services industry especially, and we are built to make sure that we address this on a measured and a time-based basis.
So, you know, I'm just trying to understand what that translates into in terms of immediate margin pressure. At the end of the first quarter, your EBITDA margin was at around 23.3, which was almost a 200 basis points decline over the previous quarter, quarter on quarter. So will this reality mean more pressure, at least in the interim, or will you be able to hold at least the 23% band?
Just to give you a background, the 23% EBITDA that you talked about was after adjusting for a one-time cost that I talked about in detail in the last quarterly call. If you adjust for that, we are at about the same 25.6, 26% number that we have been doing for the last 4 quarters. That said, I've always been cautious in guiding on the margin front. I've been saying that sustainable margins should be in the range of about 22 to 24% because we don't want to say no to business. We don't want to say we want to retain people. There are certain immediate costs that would have to be taken. So we had done a compensation change in January, Q4 of last year, which was effective Q1 of this year. And, you know, replacements are also being done at market prices. So compensation has a way of catching up to the demand. At the same time, you try to match up with the various levers that you have. So utilization is a lever. Pricing is the rates that we get from our customers is another lever. Third is the geography mix. So if you look at it, we have always been, we have got to leaning towards US as a geography of focus for us. And that geography is the first and the best to adapt to digital requirements. And so to that extent, they are also open to increasing rates and prices because they are also aware of this. Thanks to all of the press and all of the attention that's being given to the supply side challenges, customers are also now open because they also know that if you need new talent and delivery to be done on a time-bound manner, you need to make certain investments. So they are also open to talking about rates. And right now, many of the new deals are not starting basis rates. It's basis how can you achieve the solution? How can we bring in the efficiency? How can we talk about bringing down the costs on a recurring basis? These are the things that people are talking about and not immediately rates. So that's a huge change that you're seeing on the demand side. And on the supply side, yes, I would like to believe that this is temporary and we would like to hold on and continue to backfill, make adjustments as required to meet the market necessities and the market realities and go forward.
Okay, we will leave it at that, gentlemen. Thanks a lot for joining us. So that's Happiest Mind, given you an 8 times return since its issue price, been a big mover there. Let's do one thing. Let's take a quick commercial break on that note. But up next, on the other side of the break, our technical experts will be joining us. Mitesh Thakkar and Srikanth Chauhan will give us some trades for the day, all set for record highs today.